AIM stocks have been the underperformers in the markets over the last 3 months in the third quarter, while the FTSE 100 has been down around 0.9%. The FTSE AIM 100 is down almost 7%. What's this mean and what's it provide in terms of opportunities? Well, Chris Boxall, a specialist in small cap stocks, joins us now from Fundamental Asset Management. Chris, welcome.
Hello.
Hello there. We've spoken before about a lot of these small cap stocks, and you give us an insight into what's going on. But how do you appraise the developments over the last 3 months?
Well, the AIM index is always a bit of a dodgy barometer, as you like to call it, and it's been driven the last quarter by some big stocks falling substantially. And the largest of all, the biggest AIM company, Burford Capital, has seen its share price, it's down more than 50%. And that Burford Capital was circa more than 3% of the index. So that's a big impact on the index return. But as well, results season hasn't been glorious for many stocks. And when the highly rated stocks that have been momentum driven suddenly disappoint, or when there's a whiff that they're not, the growth may be slowing, you can see some massive corrections very, very quickly. One stock we do still hold, called Quicksand. I mean, it saw its share price fall 40% in a day, just like that. Because you have, people are buying into a growth profile and they're like, oh, what's happened to growth? We're going backwards now. Why am I paying a premium? And it doesn't take much volume when the shares are very tightly held to see the share price absolutely tumble, and institutions can't get out. It's just a lot of retail selling. Yeah. That's great. Can create a great opportunity.
You mentioned the environment in terms of earnings, but what about Brexit? What about sterling? What about some of the other fundamentals in the market?
You've got Brexit in terms of real impact, in my opinion, and you've got Brexit as an excuse that some companies are bringing. I mean, AIM has the benefit of lots of small companies with a lot of international exposure, and they should be big beneficiaries of very weak currency. There aren't any trade issues at the moment. Brexit has not been formalised, so they have been doing really well on weak currency, and a lot of those, the earnings are maintained. Some of them are on flakier ground, and I feel they're using it, often Brexit, as an excuse. But in fairness, Brexit has delayed things for some. It's true, and created a lot of uncertainty among investors. A lot of investors saying, oh, I'm not going to go in the market until this is all sorted out. But when's it going to be sorted out? We said that 6 months ago, a year ago, 2 years ago. How long is this going to take?
Fundamental Asset Management, you provide a portfolio service. Just remind us what it is you look for in terms of qualifications for stocks, because I think it's important to get an understanding about how you're approaching this.
The largest element of our AIM portfolio is invested for inheritance tax planning purposes. So we have to identify AIM companies that qualify for inheritance tax planning purposes. And while there are a lot of those, circa 600 plus, 650 approximately, out of the 990 on AIM, realistically only about 260 to 300 investable. So we take it down a bit more to within our universe. So they qualify for inheritance tax planning purposes. Inherently, they're good, profitable, developed companies, and typically we like a lot of insider ownership. We like management to be aligned properly with outside shareholders. That means we want them to have a real stake in the game. Now, sometimes that's artificial through option exercises. We like management to put their hands in their pockets or develop the business from scratch, founded the company, know every single element of the business, know about the accounts, the shop floor, the warehouse. This is great. That's what we want to look for.
With that in mind, you've brought along 3 stocks you think have been beaten up to the point of being...
Two in particular are very beaten up, and one is inherently a very good company that's fallen out of favour, I think.
Mm-hmm. Let's start off, if we can, with Advanced Medical Solutions that you've got here.
Yeah, this is the very good company. It's one of AIM's larger companies, circa 500 million plus market cap. It's very profitable. Margins are operating margin touching 30%. It has had a stupendous growth profile. It specialises in wound care, surgical dressings for operating theatres, for the hospital, for the healthcare sector. So this business, it takes a long time to develop and get embedded in a system, but once they're very hard to unseat. So reliability of revenue, decent visibility, and new products coming on stream again in a very, very large market, a growing market. Big exposure to the United States. Now, What's happened with this business is clearly, just one look at the graph will tell you, people probably think it's gone X growth, or there is a concern. And what happened in the current year is they've experienced delays in one of their key products in the US market. One product represents about 20% of their revenue, called Liquiband, and it had its poor sales. It underperformed in the first half of the year. And other products have been going great guns. They have also made an acquisition, quite a costly acquisition of a US company, again involved in a wound care product, which isn't yet commercialized. It's yet to go on stream, or taken about another year or so to start selling into the market. But again, that looks really, really exciting. But that's going to be diluted to earnings in the short term. So you're seeing EPS come off a bit. Mm-hmm. We feel this is, as I said in the first, an inherently very good business, decent cash generation, much of which is ploughing into R&D and new products. It's one of the three companies that we're talking about now that was kicked off in the early 1990s. It's been on AIM a while. It listed at 8.5p. I mean, what are we at now?
£2.45. Yeah.
I mean, it must have a few fans amongst shareholders. Yeah. And I think this presents a good opportunity. It's got a lot of cash, 60 odd million pounds of cash. And I think it represents an interesting entry point for long-term holders.
So are you buying this? So do you have an interest in the stock?
Absolutely. We've got an existing interest. We've got a good position across many of our AIM portfolios, and we're buyers and more enthusiastic buyers now. There may be some short-term headwinds. They've said they're going to catch up. The US is looking better in the second half. They said implying they're going to catch up. Europe's growing close to double digits. They've got, as I say, another product coming on board in the US to encourage buyers, their sectors. Interesting one at this stage.
There's a sterling play here as well, presumably, isn't it? Because overseas
manufactured in Cheshire, I think. There's a site in Plymouth. There's an overseas player as well. UK corporates got a for sale sign up over. If this thing gets cheap, I would expect an overseas buyer to be very, very interested in this business.
Okay, let's move on to the second one.
Okay.
Animal Care Group, which is a veterinary...
veterinary pharmaceutical business. It had an identiship business at its core, which grew like mad a few years ago when all pets and dogs had to have chips in them. So that went flying and fell off. But it's been developing its own brands, its own products. What happened? This was a great performer, lovely little business, net cash, everything's going delightfully, and suddenly it gets involved in a reverse takeover with a business called Equifar, which is a Belgian-based business. Clearly, it's been a struggle since then. Equifar developed through acquisition, grew through lots and lots of acquisitions, big debt load. Reverse has resulted in Animal Care carrying a heap of debt now, or easily manageable because cash flow is very good, but there were evidently some things to clean up. The former CEO of Animal Care was replaced by an Equifar person. The Equifar person dropped down from CEO and subsequently, and we've got a new CEO since October. What I like about it at this stage is you get the sense that the new management team, led by the new CEO, are really focusing the business on some core products, because they were starting to get very diverse. It's very hard if you're a small company to start ploughing money left, right and centre. You've only got limited resources. So focus on those key money makers, which sounds like they're doing, and make the most of it, and get that debt down. It's trading now at a relatively modest multiple, about circa 13 times current or next year earnings. So not so much growth is anticipated, and it won't take much for that to change. They could easily, if things improve as we hope, this thing could really perk up very quickly.
You positioned on this stock?
We are. We had a long-term position, then stopped buying. Since they've stopped buying since the Equifar deal was hated. We got an opportunity to participate, but I really didn't like it at all, thankfully. So we maintained this is how we work. We maintain the position. We keeps your our skin in the game. Keep an eye on things, and we're starting to buy in bits and bobs now. I think it could be an interesting time. It's worth taking the risk. You get to the point where you see all these super high valued things, and it comes to the point you've got to unfortunately take on a little bit more risk.
And you're seeing evidence that they're paying down debt. That's come through.
Yeah, that's important. That's important to us, paying down debt. Cash flow is pretty good with this one as well. So cash is supportive of debt reduction.
Yeah. Let's go on to number 3, war paint. Again, it's another one we've spoken about before, isn't it, war paint?
Yeah, it is. This one's really been through through the wars. It kicked off. It hasn't been on AIM for long. Listed at about 90 odd p. Flew up. It was a lovely business with high margin, colours cosmetics, focusing on mass markets, 16 to 30-year-olds, great cash flow, chucking out a dividend. The owners offloaded half the business on IPOs. They took off 20 odd million on IPO, but they still retained 50% shareholding. Joint CEOs, which is somewhat unusual. And things were going really nicely. The ticker W7 and the key product W7 is named after where it kicked off in West London, the postcode. They had that product, and which has been going really well. Everything's good. Then they get hit with diabolical UK high street, diabolical UK trade, diabolical Christmas trade. They made an acquisition called Retro, which brought another product called Technique, which is very Christmas trading oriented. So they had a double whammy then, and it fell off a cliff, as you can see. What we were talking about, it doesn't take much, whether it's relatively illiquid, closely held by a few holders, for relatively few shares traded to see the shares tank as they have done. But it's starting to look more encouraging. Growth in the US is really going nicely.
What does the balance sheet look like in terms of cash?
Still got no debt, no debt, net cash positions, not about a couple of million, I think. Cash generative, maybe actually a bit more, about 3. Cash generative, it's still committed to its dividend, who I thought looked a bit rash. So you've got a yield of nearly touching 8%.
Yeah, because of the drop in share price.
Yeah, which many will look at and think, well, is this sustainable? And if they have a blip for the second half of the year into Christmas, it may not be sustainable. But again, I think it's a decent business. I think their credibility, management credibility has been, you pocket a load of money from incoming shareholders and then disappoint henceforth.
Are you waiting and watching then till you get a better idea of how they're approaching Christmas?
We invested initially, we've held again, much like animal care, we held our ground, but haven't been investing since things looked very, very shaky. But we're starting to tiptoe back in.
Okay.
Nice one again, could be a nice one for long term. If it recovers, this could be meaningful.
Yeah. Okay, well, it's good to talk to you about some of the thoughts you've got in the AIM market. Clearly, there are some stocks there that have been beaten up to the point of being attractive, which is all about where we are in terms of the current market cycle. That's Chris Boxall from Fundamental Asset Management.